Okay, so additional to that, we are also going to discuss the sources of income of the individual taxpayers and the classification of taxes or a type of taxes of the individual taxpayers based on their income. Our learning objectives here is to discuss the concept of income, to identify the classification of income subject to tax, to identify the taxability classifications of income, to explain the personal exemptions, to compare the income tax rates under Section 24A versus the trade law, and also to cite an illustrative computations on getting the income tax payable and refundable if there is any. Okay, so let us define what is an income. So according to the BIR or the National Internal Revenue Code, income refers to the earnings. It refers to the earnings of an individuals that we derive from the following: employment, okay, especially if the individuals has a formal employment with the company. Excuse me. Business or investment. So there are also individuals who engage in business, and for whatever their profit there, that will be their income. Individual also, the income of individuals also can earn on both employment and business. And also income is the earning of an individual that based on the sale or exchange of properties, regardless if the properties is ordinary or capital assets. And please take note that income for whatever source derived within the Philippines and outside the Philippines, that we called it as income. So it explains a lot of things based on the regulation, BIR rules about the income. So if we talk about the sources of income, we also use the status of taxation because the status of taxation classifies a type of a classification, or it classifies a type of taxpayer, the income earned, and what are those incomes subject to tax. Okay, so the sources, it may be the earnings derived from all over the places for as long as it is under the territorial jurisdiction of our Philippine tax law. And please take note, based on the definition that we defined earlier, that income may be earned within the Philippines, outside the Philippines, or partly within and partly without or outside the Philippines. Excuse me. So income of individuals has the following classifications. And what are those classifications of income of individuals? Of course, the first is the compensation income. So as I had said earlier, we define the income. This is the income earned by individuals in a form of employment. An individual who has a formal employment in the company who receives a remuneration. So the remuneration, those are the compensation and the benefits. But compensation income is about a salary, a wage, or a commission of an individual. So that is compensation income. Another type of income of individuals is the profession or business income. And the professional income is income derived from exercising of profession. An example of that are the example of income from profession are the doctors who used to practice their profession, and it's a professional fee, together with the lawyers, engineers, architects, or any form of profession which they exercise, that is a professional income or a profession income. While the business income, this is the income that earned by the entrepreneurs or the people who engage in business. It's about how the individuals utilize their capital. Okay? So, and also the business income are the gains that can be earned or derived from the sale or conversion of their assets or capital assets of their business. Okay, so those are the examples of profession or business income, the net income and the business gain or gain from the sale of assets used in the trade or business. The third one is the passive income. The passive income is an income of the taxpayer which awaits or which waits for the income or for the amount to come in. Okay, an example of the passive income, if you have an investment from the bank or in the corporation by means of a stock, once your corporate stock earns a dividend, that is the passive income. If once your investment in the bank earns an interest, that is the passive income, because that's a taxpayer can merely await for the amount to come in. If you are joining a jackpot in a lotto, okay, and then you won the jackpot prize, then that is the passive income. And if you join on the game shows, or the prize and winnings on the game show, like in Wawa Win, Tutok to Win, or in Itbulaga, okay, and you won a cash prize, that is the prizes and winnings, and that is a passive income. Okay, the fourth one is the capital gain. So a capital gain is also a source of income of individuals that those personal assets, take note, personal assets, which are not used in the trade of business, that once it is already sold, okay, to another person, and the proceeds on those personal properties are to be called as capital gains or capital gain. So those are the sources, the classification of income of individuals. Okay, so now let us now classify the income which is subject to tax. If the individuals earn a compensation income and profession or business income, that is subject to normal tax or basic tax. For the passive income and capital gain, that is subject to final tax. Okay? So what's the difference of the normal or basic tax and even the final tax? The normal tax, this is the regular tax imposed upon the earnings of the individual that ranges from 5% up to 32%. And these 5 to 32% are under the old regulations of RA 8424 or the National Internal Revenue Code. But because of the RA 10963, which is amended by Duterte, the trade law, and that is the RA or the Republic Act 10963, the normal tax on individuals was shifted to 0 to 35%. And later, I am going to compare or to show you the comparison or the difference between the normal tax rate on individuals towards the RA 8424 or the Tax Reform Act of 1997 or the RA 10963 or the Tax Reform Acceleration and Inclusions Law of 2018. Okay? So please, that is the tax on individuals. But for the corporate taxpayer, there is a normal tax of 30%. Okay, so the next one is the final tax. The final tax, this is the imposed on the earnings that has been subjected to withholding tax payment by the withholding agent, and it is constituted as a full and final payment of the income due from the payee on income like capital gains and passive income such as interest income from the bank deposits and dividend income. So please take note that the final tax is not subject for the income tax return because this is a direct tax. The final tax is also a direct tax that can be directly payment by the taxpayer once they earn a passive income and a capital gains. The next is the income tax return or the ITR. The income tax return, this is a formal statement of the individuals to be submitted to the BIR under the BIR Form 2316. This is the annual income tax return. This is a formal statement that summarizes all the income earned, the expenses incurred during the year, the taxable year, and excuse me, and the tax to be paid for the whole taxable year. Excuse me. So please take note that for whatever the tax you paid in a taxable year, it should be reflected to the income tax return. But again, as I had said earlier, that the final tax is not being included from the gross income of the individual taxpayers. Like the passive income and the capital gains is not included in the gross income when you file the ITR because final tax is not subject to the income tax return. Okay, please take note that the summary of the taxable income. So if the taxable income is subject to normal tax or basic tax, it is a requirement to file for the annual income tax return report. And for the final tax, if the taxable income is subject to final tax, there's no need to report or to file an income tax return. Okay, so next is the taxable income. The taxable income, these are the pertinent items of goods of gross income enumerated in the tax code, less the deductions and personal exemptions if there's any. The taxable income is the tax base or the basis of computation of the normal tax of individuals, and even the computation of the final tax. Because the taxable income is the basis on the tax rate which it covers on the income bracket under the normal tax on individuals. Later, I will show you the computation and discussion. Okay, so please take note that the gains, the net income, the compensation income are entitled for the taxable income. So if there are no available deductions from your income, so your gross taxable income, your gross income, that will be considered as a gross taxable income. But if there are allowable deductions from the gross income, then you must deduct that together with the personal exemptions, and that will be a net taxable income. So what are the requisites or the requirements for income to be taxable? Of course, from the logic, there must be a gain profit or profit. Because if the business suffered from the losses, or if an individual suffers from the losses or break even, then there will be no income tax to be paid by the individuals. For as long as if the individual has earning a profit or a gain, then there will be an income taxable. Okay, another one is the personal exemptions. Personal exemptions, these are the authorized by the law to be deducted to the gross income to cover the family expenses or the personal living expenses of the individual taxpayer. But please take note that this personal exemption, do not forget that this personal exemption under the RA 10963, it is already abolished. So because we are now applying the RA 10963, so this is no longer included for the deductions on gross income or net taxable income. The question is, why do we need to discuss that if it is already abolished under the RA 10963? The answer first is for educational purposes. And it is part of our module. That's why we have to discuss in comparison of the computation of the taxable income under the RA 8424, which is the Tax Reform Act of 1997 and the trade law. We have to compare on how to compute for the taxable income and the income tax due or income tax payable. The second one, if you are an accountancy student, it is part of the CPA board exam because taxation is a major subject for the accountancy, and this kind also appears in the CPA board exam, even though we are now under the RA 10963. So it is only for educational and knowledge purposes. Okay, so the personal exemption under the old rate or the old code, that RA 8424, it will be deducted from the gross income. Okay, so and what are those kinds of personal exemptions? Okay, so the kinds of personal exemption, the first one is we have the basic personal exemptions of 50,000, okay, of individual taxpayers. Okay, regardless if the status of the taxpayer is single or married. Okay, so that will be that the amount of the basic personal exemptions. That is 50,000. And for the additional personal exemption, so if the taxpayer is married or a single parent, for as long as they have children or a child, this child or children can be qualified or can be filed as a qualified dependent of the taxpayer, and there will be an additional personal exemption of 25,000 for each qualified children or qualified dependent. But please take note that in declaring the additional personal exemption, it's only limit to 4 children or maximum of 4 qualified dependent to be declared. So regardless if your children is 5 above, only 4 is the maximum children to be declared as qualified dependent for the additional personal exemption. So what are the requirements of the additional personal exemption to be a qualified dependent? So your children or the taxpayer's children or kids, it should be legitimate, illegitimate, or legally adopted child, dependent for the chief support and living with the taxpayer. And of course, the qualified dependent should not be more than 21 years old. And these are not employed, okay, and single, okay, single or unmarried. But in case if your qualified dependent is a person with disability, there is a physical or mental impairment, regardless of the age, and for as long as they're incapable to live, to support himself, and it is under the chief support of the taxpayer, then that will be a personal exemptions, as additional exemptions rather, as a qualified dependent. Okay, for the husband and wife, please take note when they declaring additional exemption, only one of the spouses, okay, can claim it. It's either the husband or the wife only. As a general rule, when it comes to additional exemption, the husband is the proper claimant by law, because for being the head of the family. But the wife, please take note that the wife also may claim additional exemptions of their qualified dependent for as long as the husband waive his right of the additional exemption in favor for his wife. The husband has no income. Maybe the husband is unemployed or no business. Or the husband works abroad and there is no taxable income in the Philippines. So in this case, the wife can claim the qualified dependent as additional personal exemptions. So for legally separated spouses, okay, for whoever the custody of the child was, or for each of the those separate parents for the custody of children, then that would be subject for additional exemptions. Let's say if the custody of the child is from the mother, if we go to the mother, then the mother will be the one to declare the additional exemption for the qualified dependent, okay, as an individual taxpayer. Okay, there are times that regardless of our status in the personal exemptions, please take note for whatever changes of status that we have, it might be or it can be included during the taxable year. It means for as long as those changes status is during the taxable year, it shall be applied for whatever the rules on the status of the taxpayer and the dependent. But on the following year or the following taxable year or next taxable year, for whatever change of the status of the taxpayer and the qualified dependent, it will take effect. Okay? So let's have the example here. Or let's say you are let's say an individual taxpayer marries of course marry his couple or partner. Another, during the taxable year, a taxpayer raised a child or his child was born by his mother during the taxable year. Can the taxpayer claim for the qualified dependent or additional personal exemption for the taxable year if they have a child? Of course, the answer is yes, because it is still covered during the taxable period. Okay, but it is not included, but it's not, if the children was born on the following taxation period, then it will not be included for the existing taxable year. Another is if the taxpayer dies together with the estate. Can the taxpayer claim the personal exemptions during the taxable year even though he's died? Yes. He still can cover for the personal exemption. Let's say October 22. Am I right? Yeah, October 22 of 2015. A taxpayer dies. From January to September or October 21, the taxpayer lives. So, and if they earn income, then their income is subject to tax. But when it comes to personal exemption, because he dies on the taxable year of 2015, then the personal exemption upon his death, it can be also included to deduct in their gross income. Another case is if your qualified dependent may reach 21 years old, but this time your child is married and there is a job to support his wife or to support her daughter-in-law. Okay, so in case that your qualified dependent is 21 years old and they have worked and married during the taxable year, the qualified dependent can still, take note that, can still claim as a qualified dependent during the taxable year. But on the next taxable year, it may not allow this dependent of 21 years old because on the next taxable year, he or she will become 22 years old and is no longer to be qualified dependent as additional exemptions. Another, if the spouses are legally separated, It's on the part of the wife and husband to discuss to combine their additional exemptions with each other, not only the husband or the wife. Okay? It may be combined between the two about the qualified dependents, but the maximum is 4. If there are no specific rules for the above mentioned, then the status of the taxpayer at the end of the period, it shall be determined as the personal exemptions of them, regardless of the status. Okay, so this is the matrix or the change of summary, which we discussed. For the individual taxpayer, during the taxable year, okay, it can be declared the personal exemptions, especially the married, but for the people who died during the taxable year is included in the personal exemption, but the following year, it's not. For the qualified dependent, of course, if your qualified dependent is born or there is a new baby born, of course, it will be included in the tax exemption during the year and the next year. But if your qualified dependent reached 21 years old as a normal child during the taxable year, it may be included as a qualified dependent, but on the next school year, it is not. But if your qualified dependent is mentally or physically impaired, okay, regardless of the age, they can still claim for the additional exemptions, okay, during the taxable year and next taxable year. But for the qualified dependent, who are going to marry, gainfully employed, and die, they are still claimed by the taxpayer to be a qualified dependent as additional exemptions during the taxable year, but on the next taxable year, it will not, or they are not to be declared as qualified dependents. Okay, so that is the rule on the personal exemptions. Another exemptions to be deducted in the gross income is the health and hospitalization insurance premium or HHIP. This insurance is taken by the family that can be used for himself or for themselves. The HHIP can be included as a personal exemption for as long as the family, the gross income of the family will not reach 250,000 above in a year. Okay, in a year. Okay, so meaning if the family did not earn more than 250,000 in a year and they have insurance, it may be included in the personal exemptions. So please take note, for whatever the amount of the additional exemptions, that will be also equivalent to the HHIP. So if the additional exemption is 25,000, then the HHIP is also 25,000 either. So please take note of the following classification of the taxpayers that also allowed for exemptions. So if the taxpayer is a resident citizen, non-resident citizen, and resident alien, the HHIP and the personal exemptions, they are allowed to take it. Okay? For the non-resident alien engaged in trade and business with reciprocity, they only allowed personal exemptions, but the HHIP is not allowed. For the non-resident alien, okay, engaged in trade and business without reciprocity, and non-resident alien not engaged in trade and business, they are not entitled or they are not allowed for the personal exemptions and even the HHIP. Okay, so let's proceed to reciprocity. Reciprocity, we mentioned it earlier on the classification of taxpayers about non-resident alien engaged in trade and business with reciprocity. Reciprocity, this is the foreign country of the non-resident alien engaged in trade and business, allows personal exemption to the Filipino on their country, okay, without any reside, or they are not living with the country. If this foreign country allows the Filipinos for the personal exemption, then the Philippine government will also do a personal exemption on that foreign country. Example, in United States, okay, in United States of America, if they allow Filipino citizens for the personal exemption of paying their taxes in the US, then also the Philippine government applies to the Americans for the personal exemptions, okay, in the Philippines, because they allowed Filipinos to have a tax exemption or personal exemptions to the gross income. Please take note, the ruling on this reciprocity is for whichever is lower on the personal exemptions of a foreign country and the Philippines, it shall prevail. So I'll repeat, for whoever the exemptions of the foreign country and the Philippines, for whichever is lower, that will be the applicable exemptions. And please take note that amount allowed under the tax code of the Philippines, as I've said, whichever is lower. So look at the following examples here, or the following cases, okay? Let us compute for the personal exemptions of Juan de la Cruz. So let's read the problem. Juan de la Cruz married and had the following dependents during the current taxable year. So what are those dependents during the taxable year? Juan de la Cruz has 4 legitimate minor children. Juan de la Cruz recognized a natural child with current common law wife. Juan de la Cruz has his common law wife. Juan de la Cruz is physically disabled, brother, minor, unemployed. And Juan de la Cruz has a physical parents, or they have also parents who are entirely depending on him. So the question is, how much is the personal exemptions of Juan de la Cruz? Okay, so let us compute. Okay, so let us analyze the qualified dependents one by one. For legitimate children, yes, it's a qualified dependent. What about a recognized natural child? Yes, that is also a qualified dependent. What about the common law wife? Of course not, or no. We are not entitled to exemptions. What about the physically disabled brother, minor, unemployed? Of course, that's a no also, because we're talking about qualified dependent of a kid, which is your son or daughter who have mental and physical impairment. But when it comes to your sibling, it's not. Okay, and then the parents who are chiefly dependent and living with him. Of course, no. There will be no exemption. There will the last part is not a qualified dependent, and that is not subject to additional exceptions. So to summarize, okay, the total number of qualified dependent is 5, di ba? For qualified children, minor children, and for the natural child. But please take note that we have a rules. If the qualified dependent is 5, only 4 qualified dependents can be declared. Okay, so if it's the 4 is maximum, 25,000 times 4, that is 100,000, plus the basic personal exemption of 50,000 on individuals. So the total of 150,000. Okay, so that is the example on the personal exemptions. Next, case number 2. Okay, let us compute for the taxable income of the taxpayer together with the classifications. A taxpayer married with 2 qualified dependent children had the following data for the current taxable year. So this taxpayer has an income in the Philippines, has income in abroad, of course, and they have also expense in the Philippines and expenses in abroad. So the question is, how much is the taxable income using, assuming that the taxpayer is a resident citizen? So let us compute for the income tax payable. So I'll repeat, we are just computing for the income tax payable, okay, not the income tax payable. The taxable income, okay. please take note, we are going to compute here about the taxable income, not the income tax payable. Okay, taxable income. See, taxable income, this is the basis of computing the normal tax of individuals. This is the basis. So we are computing the taxable income. Okay, so if the taxpayer is a resident citizen, as our ruling, income within the Philippines and outside the Philippines is subject to tax. So we have to summarize the gross income in the Philippines and abroad. So with a total of 900,000, less expense in the Philippines and abroad, that's 280,000, with a total of net income of 620,000. But that's not ends there, because we have also to deduct the personal exemptions. First is the basic personal exemptions of a taxpayer, which is 50,000. And of course, the two qualified dependent children, 25,000 times 2, that's 50,000. So therefore, the total exemption is 100,000. And if we deduct the personal exemptions to the net income, so the taxable income of the taxpayer, if he or she is a resident citizen, that's 520,000. Okay, the question number 2, compute for the taxable income assuming that the taxpayer is a non-resident citizen. So let's follow the rules. So if the taxpayer is a non-resident citizen, and therefore only income in the Philippines is subject to tax. So only the income in the Philippines must be declared. So gross income in the Philippines, 650,000, less business expenses, that's 150,000. So the net income is 500,000. And less personal exemptions, okay, same data, 100,000. So the taxable income is 400,000. So the 400,000 is the taxable income that will be the basis to compute for the tax income payable of the taxpayer. Question number 3, how much the taxable income from the resident alien? It's just the same with number 2 as a non-resident alien, 400,000, because they have same level of additional exemptions and HHIP. Okay, the fourth one, how much is the taxable income assuming the taxpayer is a foreign country allows a Filipino for the personal exemptions, okay? Especially, we must compute for the taxable income of a taxpayer who is a non-resident alien engaged in trade and business. And let's say their country, okay, accept Filipino citizen for the additional exemption. So therefore, our Philippine government may use to apply exemption to that other country. So let us compute for the income tax payable or the taxable income. So resident alien, subject income subject to the Philippines only. So same data, okay, but this time the personal exemption are different. Okay, so what is the given data for the basic personal exemption? For the foreign country, 60,000, but in the Philippines is 50,000. So we adopt the personal exemptions in the Philippines, which is 50,000. For the additional child, of course, 20,000 per child in the foreign country, but in the Philippines is 25,000. So therefore, whichever is lower. So 20,000 per child is, for the foreign country, is allowed. So instead of 25,000, so 20,000 times 2, that is 40,000. So the total exemptions is 490,000. So the taxable income for the non-resident alien engaged in trade and business in the Philippines is 410,000. And of course, the last question is how much is the income, is the taxable income, assuming that the taxpayer is a non-resident alien not engaged in trade and business in the Philippines. So please take note that those non-resident alien not engaged in trade and business, they are not entitled to personal exemption and HHIP. So therefore, it's just a basic computation of the gross income less expenses or allowable deductions. Okay, so if the taxpayer is a non-resident alien, then income in the Philippines is subject to tax. So the gross income in the Philippines, 650, less business expense, 150. So the net taxable income is 500,000. Okay, so there will be no personal exemptions because they are a non-resident alien not engaged in trade and business. So those are the computations of the taxable income based on the classifications. Okay, so let us discuss now the pro forma computation of taxable income. So this is the format, okay, the format on how to compute for the taxable income. So the first one is if the taxpayer has only earning a pure compensation income. So the pro forma calculation or computation, we have to summarize the gross compensation income and then less basic personal exemption, additional personal exemption, and HHIP premium payment. So that will be the taxable compensation income. Okay, so the taxable compensation income, we will have to compute for the tax due, which is the tax base. Okay, and for whatever the tax due, if there are some tax credits, it should be deducted, and that will be the tax payable or refundable. But if there are no tax credits like withholding tax on compensation, then the tax due is the taxable income. Another is the pro forma computation of income, especially for those people who engage in business. Okay, so we have to summarize the business income or the gross business or professional income, and less allowable business expenses, personal exemption, additional exemption, and HHIP. So the taxable income for the income from business, okay, then let's compute for the tax due. So that the taxable net income is the basis for the tax computation. So that will be the tax due, and if there are some tax credits to be deducted, it must be deducted if there are tax credits. And then after the deduction of tax credits, there will be a tax payable or refundable if there's any. But if the tax credits are not available, the net taxable income, the tax due, or if there are no tax credits, the tax due that will serve as a income tax payable. But for the mixed income earners, when we say mixed income earners, those are the gross compensation income and the business income. They are to combine or consolidate with the total income, less allowable business expenses, personal exemption, additional exemption, and the HHIP. That will be the taxable net income. So the net taxable income is the basis for the computation of tax, and that's a tax due. If there are some tax credit to be deducted to the tax due, then it must be deducted, and after that, that will be the tax payable or refundable. But please take note, if there are no tax credits to be deducted, the tax due is the tax payable or the income tax payable. So those are the format or the pro forma computation of the following taxable income of individuals. Okay, so let's proceed now to the RA 8424 normal tax rates. This is the section 24A of the tax code under the RA 8424. This is the old, and this bracket, this section 24A are used from year 1997 up to 2017. Imagine, this is applicable for 20 years. It is used for the year 1997 up to 2017. It's been 20 years since this normal tax on individuals are used. As you can see here, look at this. The normal tax was started from range 5 to 32%. That's correct. That's the old one. And look at the income bracket. It's only small. Because during the time of 1997 onwards, before 2021, the money, our money, the currency is good. That's why on that time, 10,000, 30,000, 50,000 is has a value or highest value at that time. You imagine, no? The maximum revenue is 500,000 above. And this is the normal tax. This is the initial tax, and this normal tax are additional tax, okay, to the individuals. Okay? But look at this. This is the RA 10963. As you can see, this is the pilot implementation of the RA 10963 or the train law. As you can see the difference, okay, look at on the income bracket before, and this is after. So what only changes here in the train law of Duterte is to increase the income tax bracket from 0 to 500,000. And right now, Duterte made from 0 to 5 million. And from those income earners who earn 250,000 below, that is a zero rate. It means there will be no tax to be collected or to be paid by the taxpayer. But if the earnings of an individual is more than 250,000, that is subject to basic tax of individuals with the normal, with the initial tax and additional tax. Okay, so from the old, we have 5 to 32%. Under the train law is from 0 to 35. This is the pilot implementation of the train law from 2018 up to 2020. But on year 2021, which is right now, we are on the 2021, there is a full implementation of the train law when it comes to the normal tax on individuals. So they used to decrease, some of the rates. Look at this. On the pilot implementation from 250 to 400, 20% is the normal tax. But here in the 2021, it was 15, together with the other ranges. Okay, so that is the comparison of the income tax bracket of the RA 8424 and RA 10963. Okay, so do not be confused. So this is the old rate. It's not already available because it is abolished by the government. The reason why Duterte made a train law, because according to the study, that the Philippines has the highest income tax on individuals in the Southeast Asia. That's why Duterte, they used to create a train law under the Republic Act, okay, and it was passed by the Congress, okay, to give way to the individual taxpayers to increase their purchasing power. And because the tax rates are reduced, then there will be no personal exemptions to be deducted. Okay? Take note, under the RA 10963, there will be no personal exemptions to be deducted. Okay? There's no lot things to be deducted since the normal rates or the normal tax rates are adjusted. Okay? So let's have the following illustration or example. Okay, so what are the example? We are going to discuss the example rather, okay, in the application to compute for the income tax. Okay, let's have the case A. In the case A, the income and expenses of a Filipino citizen for the current taxable year are summarized as follows. From January to June, the taxpayer earns from the Philippines and Canada of 5 million and 2 million. From July to December, okay, the taxpayer earns from the Philippines and Canada 2 million rather and 3 million. Assuming that the taxpayer is a resident citizen who left the country and they stayed to Canada for good. Okay, so if the taxpayer becomes a non-resident citizen from July up to December, he will now consider as a non-resident citizen. So it meaning from this problem, we have to classify the taxpayer during the taxable period. So it means from January to June, the taxpayer is a resident citizen, but from July to December of the taxable year, he is not considered as a resident citizen, but he is considered or she is considered as a non-resident citizen. Okay, so let's have to compute for the taxable income and income tax payable. Okay, that's my explanation. So that's why the status is very important. So from January to June, the taxpayer is a resident citizen. From July to December, the taxpayer is a non-resident citizen. So let us summarize. So please take note, from January to June, since the taxpayer is a resident citizen, income in the Philippines and Canada are to be declared as income. So the gross income of the taxpayer from Philippines to Canada with a combination of 7 million, less allowable deductions of 3 million, with a combination of 2 and 1 million, and the net income of the taxpayer from January to June as a resident citizen is 4 million. But from the July to December, please take note, only income in the Philippines is subject to tax. Okay, Canada excluded. Okay, Canada is excluded. So, gross income in the Philippines, 2 million. There's allowable deductions, 1 million. And the net income is 1 million. Kaya, so the taxable income, if you combine the 4 million from January to June and 1 million from July to December, so the gross taxable income or the total gross income is 5 million. Then less personal exemptions of 50,000. So the net taxable income of the taxpayer is 4,950,000. So this will be the basis of computing the income tax on the 4,950,000. So if the net taxable income is 4,950,000, if we apply the income tax bracket or the normal tax bracket of individuals, the net taxable income 4,950,000, it covers on over 500,000. So the initial tax is 125,000 and additional tax in excess of 500,000. So let us compute. I'm sorry, this is the computation rather. Okay? So the initial tax is 125,000. And then additional tax in excess over 500,000. So 4,950,000 minus 500,000, that is 4,450,000. And then multiplied by 32%, that is 1,424,000. So the total tax due or the total income tax payable of the taxpayer under the RA 8424 or the Tax Reform Act of 1997 in application is 1,549,000. But now let us compute the net taxable income and the income tax payable under the Train Law of Duterte or RA 10963. Okay, so going back to this, going back to this computation of the net taxable income, okay? So under the RA 10963, as I had said, the personal exemptions are abolished. So it means the gross taxable income under the train law is 5 million. So the tax basis is the gross taxable income of 5 million pesos. So that is under the RA 10963. Okay? So if you check, since we are now in the 2021, if the gross taxable income is 5 million, it covers here on the over 2 million to 5 million. So the initial tax under the train law is 402,500 plus additional tax of 30% of the excess of 2 million. Okay? So let us compute under the train law. So the initial tax is 402,500 and then less in excess, of course, the 5 million minus 2 million, that is 3 million, and times 30%, that is 900,000. So the tax due under the train law of the taxpayer on the case A is 1,302,500. So this is the difference under the RA 8424, and this is the difference under the RA 10963. So if you compare the computation of the net taxable income, the difference in the old regulation, there is a personal exemption, but under the train law, there is no personal exemption. So after we deduct all the allowable deductions, that is subject to income tax. And there is a difference on the amount of the tax to be paid. And there's a big difference. So is it true that the normal tax rate for the individuals are reduced? and the purchasing power of the individual taxpayers are increased. Okay? So another example, or let's say case B. Okay, same data with the case A, but this time in the case B, we reverse the status. Same data in the case A, we reverse the status. From January to June of the taxable year, the taxpayer is a non-resident citizen. And from July to December, the taxpayer go back to the Philippines and stay for good, and she is now become a resident citizen. I'll repeat. In the case B, it's the same data in case A, but it was reversed. When I say reverse, from January to June, the taxpayer is a non-resident citizen, but from July to December, the taxpayer is a resident citizen because he came back last July to stay in the Philippines for good. So let us compute for the taxable income and the income tax payable. So as I have said, this is the given data. From the January to June, it was reversed. If the taxpayer is a non-resident citizen, of course, the gross income in the Philippines is subject to tax. So the gross income in the Philippines is 5 million, less allowable deductions, and the net income of the taxpayer from January to June as a non-resident citizen is 3 million. But from July to December, he's now become a resident citizen. So income in the Philippines and Canada must to be declared under the Philippine tax. So the total gross income of 5 million, less allowable deductions of a total of 2.2 million, then the net income is 2.8 million. So if you combine the net income of 3 million, so the total gross taxable income is 5.8 million. But under the RA 8424, we must deduct the personal exemptions. So the net taxable income for the RA 8424 is 5,750,000. And this net taxable income is the basis to compute for the tax. Okay, so let's going back again to the old rate. So if the net taxable income is 5,750,000, under the old code, it should be applied on the over 500,000. So the initial tax is 125,000 plus additional tax of 32% in excess over 500,000. Okay, so let's compute. Okay, so for the old rate, so the initial tax, as I've said, 125,000, and then for the additional tax, 5,750,000 minus 500,000. That is 5,250,000 times 32%. That is 1,680,000. So plus 125,000. So the total tax due or the income tax payable of the individual under the old regulation or RA 8424 is 1,805,000. And for the train law or under the train law, RA 10963. Okay, going back to the computation, since as I have said, the personal exemptions under the RA 10963 is abolished, so there will be no personal exemption. So the total gross taxable income, the 5.8, is subject to income tax under the RA 10963. So if you check on the train law 2021, the 5.8 million, it covers on the income bracket of over 5 million. So it is over 5 million. So the initial tax rate is 1,302,500 plus the additional tax of 35% of the excess of 5 million. So let us compute. Okay, so the 5.8, of course, the basic tax is or initial tax is 1,302,500 plus additional tax. So 5.8 million minus 5 million, that's 800,000 times 35%, that is 280,000. So the income tax due or payable under the train law is 1,582,500. So that is the difference. Look at the difference here and under the old rate, okay, and the train law. So there's also a difference. And there's a big difference. So truly, that the train law reduces the tax payment. it reduces the burden of the individual taxpayers to pay the high amount of taxes and also increase the purchasing power of the individual taxpayers. So that is the comparison of the computation of the income tax payable and the net taxable income of the individuals under the RA 8424 and that which is the national which is the Tax Reform Act of 1997 and the RA 10963 which is the tax reform and acceleration and inclusions law or the TRAIN law. So that is our topic for today when it comes to the second part of the week 3, which is the tax on individuals.